Hello dear viewer, welcome back to my channel. In this video, we are coming to continue our consolidation series. So in my previous videos, what we've covered so far, we've covered the everything that has to do with consolidated statement of financial position. We also covered everything on consolidated statement of profit or loss, and now we are considering what we call associates. So this is covered, as I said in my very first video, this is covered by another standard, okay, financial reporting standard called IAS 28. That is International Accounting Standard 28, investment in associates and joint ventures. So this is the standard that covers where investments in associates as well as joint ventures. Now, joint ventures is actually part of joint arrangements, which is also under IFRS 11. Okay, joint arrangements. So we are going to cover joint ventures when we want to consider joint arrangements. So the joint arrangements can come in two forms. We have joint operations and then joint ventures. So we are not going to deal with the joint venture portion of this standard. We are going to concentrate on investment in associates. All right, so let's see what we've got here today. So let's look at some definitions. Now, these definitions, I have already given them in my very first video as well. So if you like, you can refer to them back. But for a recap, let us look at what we mean by an associate. So what is an associate? We know a parent, we know a subsidiary, we know that what connects the two is what we call control. Now we are looking at another entity here called associate, which is also part of the group. All right. So this associate is defined by IAS 28 as an entity over which the investor has significant influence. So an entity of the group over which the parent has significant influence. That is what we call an associate. All right. Now, what is this significant influence? What do we mean by significant influence? Significant influence exists when the parent has power to participate in the financial and operating decisions of the entity or the associate. All right. And this power does not give control or does not give joint control over the policies of the associate or the entity. That is what we call significant influence. So it is having power to participate in the financial and operating policy decisions of the entity. As soon as you have that power, then you are called a parent, and then the other entity over which the power is exerted becomes an associate. So that is what we call significant influence. Now, there are various indications of significant influence. Usually, a less than 50% um, shareholding in the entity gives you significant influence. But that is just the basis. There are other significant indicators, and take note of these indicators. I'm going to spell them out, so please take note of them. They come in the professional exams like anything. So just make sure you have them at your fingertips. All right. So the number one indicator of significant influence is representation on the board of directors. All right. A second one is participation in the policy making process of the entity. Okay. And then thirdly, when there are material transactions between the investor and the associate or the entity. 4, when there is interchange of managerial personnel between the parents and then the associates. And then finally, if there is what technological dependency. These 5 indicators are key when it comes to determining significant influence. All right, so that is just a quick recap of what we've previously looked at. Now, when it comes to associates, we have what we call equity method of accounting. The equity method of accounting. Now, in the consolidated financial statements, what you should know that is that we account for an associate using the equity method. The equity method, and I have defined the equity method here in a point form. So when we talk about the equity method, this is opposed to the acquisition method. Whenever there is control, when the parent has control over the subsidiary, we apply the acquisition method, and that is where we add 100% of the parent's financial statement figures to 100% of the subsidiaries figures to get the consolidated figures. That is what we call the acquisition method. But where there is significant influence, or the entity is engaged in a joint arrangement, then we apply the equity method. Now, what is the equity method? The equity method is where the investment in the entity, in this case the associate, is initially recognized at cost. All right. Then this amount is adjusted subsequently for any post-acquisition changes in the investor's share of the net assets of the associate. So we initially recognize the investment in the associate at cost, and then this amount is increased or adjusted, is increased or decreased, or simply put, adjusted to recognize the investor's share of the associate's profit or loss and other comprehensive income after that initial recognition. All right, so that is what we call equity method. So you have the cost of the assets. If there is any changes in the post-acquisition reserves of the associate, we account for it, and then we use that amount to adjust for the cost. That is what we call equity method of accounting. We are going to take an example, and you will understand exactly what I mean by that. So the amount is usually adjusted for by any changes in the post-acquisition profits. All right, so that is what I said first of all, and then it is also decreased by the amount of any dividends received from the associates, and then any impairment losses in the associates. When we progress, you understand more what I mean by this. All right, so what we are saying is that by the equity method, we mean that the associate is not consolidated line by line as we have in the acquisition method when there is control. Alright, instead, the associate is presented as a single line item, that is investment in associates in the consolidated statement of financial position. And then in the consolidated statement of profit or loss, you have a single line item called share of the profit of associates. Share of profit of associates. That is what you will have in the consolidated statement of profit or loss. So that is what we have for the equity method. Now, how do we calculate this investment in associates within the consolidated statement of financial position? So, as I said, this is what we call the equity method. All right. So, this is the equity method in action. So, we have the cost of the investment in the associates right here, and then we are going to add the parent's share of any post-acquisition profit or retained earnings or reserves, whatever term you want to refer to it. Then you subtract. So that is what I have right here. All right, that's what I have right here. Then you are going to subtract or less impairment losses, if there is any, in the associates. And then you also less provision for unrealized profits, where a trade took place between the associates and the between the associates and the joint the parent. All right, so that is what we have here. As I said, when we get into the calculations, you will understand even more. All right, so this is what we mean by the equity method. You start off with the cost of the investment in the associate. You add any profit the associate has made within the post acquisition period. You less impairment losses since acquisition of the associate, and then you also adjust for any unrealized profits on inventory that has been left within the parent books at the year end. So that is what we have. And then also you can even adjust for dividends received from the associate. All right, the dividend received from the associate is also adjusted in this particular equity method of accounting schedule we have here. Now, there are some notes here you should have at your fingertips. Now, the first one is that the differences between the cost of investment and the carrying amount. So, this is the cost of investment, and this is the carrying amount at the end of the period, which we are calling investment in associates. Now, the difference between these two figures must be matched with adjustments in the consolidated statement, in the consolidated retained earnings. All right, and this is what you are referring to. We are referring to workings 5. Do you remember the 5 standard workings? So workings 5 is where we calculate our retained earnings. Now, what we are saying is that what accounted for the difference between the cost of investments as we have here and the investment in associate, or the carrying amount of the associate in our books. So what is accounting for it? For the difference. What is accounting for the difference are these figures here. All right. So what you are saying is that these figures are also going to appear within the retained earnings working. So when you are calculating your retained earnings, which is the group retained earnings, you are going to include these figures as well. That is what we are saying. So in addition to what we already know as the calculation for group retained earnings, we are going to add these 3 items as well. That is exactly what we are saying here. All right, so I hope you get that. Then secondly, this is actually rare. It doesn't really appear in questions like that, but you should take note of it. A long-term loan to an associate is also included in the carrying amount of the investment, rather than presented as a separate financial asset investment. So what you are saying is that if you loan an amount to an associate, or if the parent loans an amount to an associate, this amount is included in the cost of investment rather than being presented as a financial asset or as an investment, a separate investment. All right. So this is also included within the cost of investment. All right. So just take note of that, so that in case you see any loan from the parent to the associate, you should not present that as a financial asset under IFRS 9, but as a cost of investment within IAS 28 framework. All right, so let's quickly look at an example here, and then we will see what all that we are talking about in English. So let's get into the calculation and see what we have here. We have this particular items, financial statements here of P, S, and then A. So what we are going to do is that we have P owns 80% of S. So from this information, we know that S is the subsidiary of P, because this is 80% acquisition of S's shares, and that gives control. What we know is that more than 50% of the shareholding gives control. All right, so this is what we call control. And 40% of A, so this 40% is less than 50%. So we can classify A as an associate. We can classify A as an associate based on this percentage holding here. All right. So S is the subsidiary of P and A is the associate of P. Now, statement of financial position of the three companies at 31st December 20x6 are as follows. So we have investment in the shares of S, investment in the shares of A, other non-current assets, current assets. We have issued capital, that is ordinary shares. We have retained earnings, and then we have liabilities. This is a simplified question, but it's going to help us understand what we mean by equity method of accounting. So just stick to it, and then you are going to get right into it. So we have P, an additional information here. P acquired its shares in S 7 years ago when S's retained earnings were $520. The non-controlling interest was measured at its share of identifiable net assets. Goodwill has suffered an impairment loss of $10 since acquisition of S. P acquired its shares in A on 1st January 20x6 when A's retained earnings were $400. During the year, the investment in A was impaired by $300. Wow. So that is what we have there required. Prepare the consolidated statement of financial position as at 31st December 20x6. So I have a pro forma consolidated financial position here as at 31st December 20x6. So as I said, this is Excel presentation. When you are presenting in Excel, you have a column for the parent figure, the column for the subsidiary figure, then you have a column for adjustments, and then you have the group figure. I explained how to present it when you are presenting manually, that is, you are writing on paper. So please, if you have not watched my previous videos, kindly watch them, because I'll be doing a lot of things here which I will not be able to explain because I've already done that in the previous videos. All right, so the consolidated statement of financial position goes as follows. So we have our current assets, and for our non-current assets, they've been given directly to us, but I'm going to put it as property. So let me call it property, plant, and equipment. Then we are going to have our goodwill, and then the investment in associates. This is just a pro forma. This is how we answer consolidated financial statement questions. So you first of all draw up a pro forma financial statement, and then you can insert your figures from the separate financial statements as presented to you in the question. So what I'm saying is that the investment in associate figure will be presented in the consolidated statement of financial position under the non-current assets column. So after we have our non-current assets and goodwill or any other investment, you will have a separate line item called investment in associates. All right. So this is how we present investment in associates. Whenever there is an associate, we present it. So what you are saying is that we do not consolidate the associate figures in the consolidated financial statements. Rather, we only have a single line item within both the statement of financial position and the statement of profit or loss accounts. All right. So that is what we have here. Then we also have another item called current assets. All right. So that is it for our asset side. Then we will have our equity. For the equity, we have issued capital. So these items are not conjuring them from anywhere. They are all here. All right. So we have now, as I said, some of the things I'm not going to explain them in this video because this video is we have entered into consolidation. So if you're not understanding anything, please go back and watch my previous videos on consolidation, and then you can fully understand what I'm doing here. All right, so we have our non-current assets there, which I've named as property, plant, and equipment. We have current assets as well. Now we go to the equity and liabilities, and then we have issued capital, we have retained earnings, and then lastly we have liabilities. So let me insert a couple of rows here. Okay, then we'll have our retained earnings. We have our retained earnings here. We also have our so after retained earnings, we know that we are going to have our non-controlling interests, also known as NCI for short, and then we'll have our current, or this one call it liabilities. So we'll have our liabilities figures there. All right, so this is our pro forma consolidated statement of financial position. Now that we have drawn up our pro forma figure, let's go and input our figures. So for my property, plant, and equipment, I'm going to link the figures here. So we have non-current assets 1,600 for the parent, and then I'm going to use Control R to get the figure there. Then we know that our goodwill is going to be calculated. So quickly I can come here, put bracket here, and then this is going to be my workings 3. You got that right? And then the investment in associates is the new item we are seeing. So quickly you should know that it's going to be our workings 6. All right, that's going to be our workings 6. So let's come to our current assets. So I'll go to my separate financial statements, and then I'm going to link up my current assets. So using Control R there. Then for my equity, we are going to use that of the parent only, as we already know. So I'll have my 1,000 there, and then we know that our retained earnings is going to be our workings 5, W5 there. Non-controlling interest is going to be our workings 4 right there, and then let's link up that of our liabilities from the separate financial statements. So I have that, and then I can do Control R to link the figures there. So we have our pro forma consolidated statement of financial position perfectly set up for us. So let's go to the workings and see what we have here. So my group structure is already here for me. It's right there. So this is how the group structure looks like. You have the parent, which is P right here. Let me expand this a bit. Okay, so this is actually something I copied from online, so just bear with me. So we have the P here, which is our parent, buying 80% of S, and then P also buys 40% of A. So we have the group, the entire group here. Then this is our associate. All right, so that is what we have there. So that's the group structure. This is how you draw up the group structure in the exams. So you can even add more information, that S, you can write here acquisition method. Then A, you can write here equity method, so that you will not be confused. You know that when it comes to S, you are going to use the acquisition method of accounting. When it comes to A, you are going to use the equity method. So that is our workings 1. Now let's come to our workings 2, which is the net assets of the subsidiary or the subsidiaries if there are more than one. All right, so the net asset of the subsidiary, there we are considering the net assets, which are, in this scenario, they are issued capital and then retained earnings. So what is our issued capital? of the subsidiary. We are going to the financial statements here, and then we are going to link up our equity capital of the subsidiary, which is the second column in the separate financial statements. So I'll hit that, and then this is for the reporting period, reporting date. Now, for the acquisition date, it does not change because we have no additional issue of shares there. Sorry, so I cannot copy that. So we have 400 also at acquisition date. Then the post acquisition is going to be 0. All right, right there. Then for the retained earnings, we know that at the reporting date, we can find that within the separate financial statements. So that is 3,400. And then at acquisition date, we've been told that the retained earnings as at the time S was acquired was 520. So quickly I'll come here and I'm going to write my 520 here. Now what is going to happen is that I'm going to leave this question within the video description so that you can go and download it and follow along, so that I don't have to be flipping back and forth to reduce the time of this particular video. All right, so the question will be left within the video description for you to download so that you can follow along. So I can copy this formula across, Control D. So that is our post acquisition profit. That is our post acquisition profit. Let me insert my border there, tick bottom border. Now I can use Alt equals, which is the shortcut key for auto sum, to sum these figures. So I'll use Control R to sum the figures right there. All right, so we have our net assets perfectly set up for us. Now, what you should understand is that in this particular question, we are only concerned about things that are going to affect our associates. So every other thing that will appear here are going to affect the parent and the subsidiary, and we are not interested in that. We have covered those things in our previous videos. All right, so we are just considering what is going to affect our associates. So that is why we have this simplistic question right here. So we have our goodwill. We know that we are going to start off with the cost of investment, and this cost of investment is in the subsidiary. So what is our cost of investment in the subsidiary? Is going to be 800, as we have already seen in the separate financial statements right there. As I said, I will not be flipping back and forth. So this is our investment in S, 800. All right, so we have it there. Okay, then we'll have the now we've been told within the additional information. So let's go to additional information. We've been told that the non-controlling interest was measured at its share of identifiable net assets. So that's the proportionate method. All right, the proportionate method. We have covered all of that in our previous videos. So we'll have fair value of NCI at acquisition, and that is going to be equal to our 920, which is the which is the net asset figure, this particular figure here. So let me link that up rather. So I'll have here 920, and then I'm going to multiply that by the fair value by the NCI percentage, which is 20%. Let me just do it 0.2 right there. And so let me insert a couple of rows here. So after getting this figure, we can sum these two together. So we have 984. Let me insert a border there, tick border. And then what we have is that we are now going to less the fair value. So let me shorten it FV of the identifiable net assets. of S. So we are going to less the fair value of the identifiable net assets of S at acquisition. At acquisition, very important. So this is at acquisition date. So where is our acquisition value? This is the value we are talking about. So we are going to subtract that from our total here. Okay, so this is the amount you have paid to acquire S, and this is the value of S, the fair value of S, but this is the amount you have paid, but this is the value. So the difference, the positive difference becomes our goodwill at acquisition date. Whenever I said at acquisition, I mean acquisition date. All right, so we have the, and then I'm going to add these two together, and that gives me my goodwill at acquisition date. Now, all right, so now to get the goodwill at reporting date, we are going to less our impairment loss, and that is going to be 10, as we have in the additional information. So when I add the goodwill at acquisition to the impairment loss, that will give me my goodwill at reporting. So this is what we call goodwill at reporting date. At the reporting date. All right, so that is what we've got there. Let me set my borders. To make the presentation a lot clearer. So that is what we have there. Now we have the fourth working, which is the non-controlling interest. So the non-controlling interest, we start off with, with the non-controlling interest, we are going to start off with the fair value of NCI at acquisition, and we already have that figure within the goodwill calculation, which is 184 right here. So this is the figure I'm talking about here. So this is the fair value of the NCI at acquisition. So you have 184. Let me unbold this. Then we are going to have NCI percentage of the post acquisition profits, and that is going to be equal to, what is our post acquisition profit? We have it in our net assets schedule. Then I'm going to multiply that by the NCI percentage, which is 20%, 0.2. So I have 576 right there. Then I can add the two together. So using alt equals, and that gives me my NCI at the reporting date, my non-controlling interest at the reporting date. So that is it for that as well. Then the fifth working is what we call the group retained earnings. So let me actually put it here, group retained earnings. And as we previously know, we start off with 100% of P's retained earnings, and from the question it is 4,000. Let me bolding this. Okay, so we start off with 100% of P, which is 4,000, and then we are going to add P's percent of the post acquisition profit. You also hear terms like post acquisition reserve or post acquisition retained earnings. They are all referring to the same thing. So here we are going to have the parent's share of the post acquisition profits, which we have in the net asset schedule of 2,880. So I'm going to multiply that by the parent's percentage holding in the subsidiary, which is 80%. So we have 0.8. All right, so that is 2304. Then what we have here is that we are going to adjust for the impairment loss. As I said, this is the proportionate share of our impairment. I've explained that within my previous video, so you can go and check that out, why we are treating the impairment loss right here. Okay, so we have impairment loss of 10, so I'll have my negative 10 there. And then what we have here is that we are going to adjust for the items relating to the associates as well. So what we have is that we are going to have share of associates, so A's post acquisition profit, post acquisition profit. So this is new. What we are saying is that after you have done what is normally done under the group retained earnings, you are going to, if there is an associate, you are going to have the share of the associate's profit here as well as the associate's impairment, if there is any, and then any associate's provision for unrealized profits on inventory. Okay, so that is what we are saying. That is what we are saying here. So I'll come here and then I'll have the share of A's post acquisition profit, and that is going to be equal to what? So what is the post acquisition profit in the first place? Let's go to our question. Now we know that the retained earnings of the associate as at the time it was acquired was 400. So that is the pre-acquisition profit. Now, what is the post-acquisition profit? That is 3,600, which we have in the separate financial statement here. 3,600. So to get our post-acquisition profit, or the profit that occurred or that we realized between the time we bought the associates and the reporting date, we are going to take the figure at the reporting date and subtract the amount at the acquisition date, which is 400. And then we are going to multiply the result by the parent's shareholding within the associates. So this is what I mean. We have 3,600, which is the retained earnings of the associates at the reporting date. We are going to subtract that of the acquisition date retained earnings, and then the result is going to be multiplied by 40%, which is the shareholding percentage. So let me put this in brackets. And then I can hit enter. So this is what we call the post acquisition profit of the associates. All right, so that is what we have there. Then another item we have in this particular question is the impairment loss of, so let me differentiate that from the first one. So impairment loss of is investments, and that is equal to 300, negative 300 right there. So that is what we have. Okay, so this is what we have. Then I'm going to add everything together because I've presented the negatives as negatives, so I'm going to add them together. so that I will have my group retained earnings of $7274. So let me bold in that and then also insert my borders right there. Okay, now we have the group retained earnings correctly calculated for us. Now let's look at how to deal with the investment in associates. So first of all, we start with the cost of investment in A. So let me just say cost of investment, and that can be found within the separate financial statements in our question. So let's go to the separate financial statements right here and pick that figure, which is investment in the shares of A, which is 600. So I'm going to pick that right there. And then we are going to adjust it for what we have done here. That is what I explained earlier. So what I can do is that I'm just going to just copy these two figures, copy them, and then I can come here and paste them right here. And paste them right there. Alright, so that is it. And then I can hit Alt equals 1580 as my investment in. It's as simple as that. So what you are saying is that whatever will cause a difference in this cost of investment which is these two items right here, is also going to be treated under the group retained earnings. Alright, so if you have already treated it here, then all you have to do is that transfer whatever adjustment you have made relating to the associates in this particular investment in associates um, calculation as well. So that is all we are doing here. That is all we are doing here. So we have that. Now that we have calculated everything, let's go and complete the consolidated statement of profit financial position. Sorry. So we have these two figures. There are no adjustments in this question. So we can actually go and then calculate our figures there. So let me have Alt equals. I have that. Then for my goodwill, I can link that from the workings. So where is my goodwill? That is 54 right here. And then for my investment in associates, I can also come here and link it from the calculation, which is 1580. And then I can add everything there together using Alt equals. So 163. Sorry, so so Alt equals including this particular figure there. So that is our non-current assets figure there. Then I can have my my current assets figure 5,500 added to the non-current assets figures as I have there, and then that gives me my total assets. So let me bold in that and also insert a border. So I'll have this right there. So this becomes our total assets. So that is it. Then we come to our group retained earnings. We come here and link that up. So sorry. So these figures, this figure is supposed to be treated here. So we have our 1,000, and then for my group retained earnings, let me go and link that. My group retained earnings 7274 right there. And then for my non-controlling interest as well, let me go and link it up. So we have our non-controlling interest, which is workings 4760, and then I can add these three together. Added those together, then I can also add my my liabilities, which are all actually two figures, 500. So this is equal to this plus. So let me have 200 and then 300. So that gives me 500. Then I can add the two together, and that gives me the same figure as my total assets. So I can come here and name it total equity and liabilities. All right, so this is how we deal with associates within the consolidated statement of financial position. All right, so this is how we deal with it. I hope you understood it. Whatever we have done here, I hope you understood it. All right, so that is it. Let's go to how we are going to treat it within the consolidated statement of profit or loss and other comprehensive income. So, as I said previously, when it comes to the consolidated statement of profit or loss and other comprehensive income, we have a single line item called share of profit of associates, and this will come under the operating profit section. It will come under the operating profit section. So that is what we have here. So let's look at the notes I've taken here. So the treatment is consistent with that which was applied in the consolidated statement of financial position. That is the investor's share of the associate's profit after tax is included within the profit or loss as a separate line item, as I already said. And then the investor's share of the associate's OCI is also included within our OCI. Where interest is acquired mid-year, the results of the share of the profit of the associate should also be time apportioned. All right, it should be time apportioned. So when it is a mid-year acquisition or a mid-year investment, sorry, so it should be a mid-year investment. If it is a mid-year investment, then the amount should be time apportioned as such. All right, we are going to look at an example and then you see how we are going to deal with that. So let's look at a simplified question here and see how we are going to treat it within the consolidated statement of profits or loss as well. So we have a question here. P owned 80% of S and 40% of A for several years. All right, the statement of profit or loss for the year ended 31st December are as follows. So we have P, S, and A right there. Then we have their revenue, cost of sales, we have gross profits, administrative expenses, we have dividend from associates, we have profit from taxation. So we have profit before taxation, we have income taxes, profit after taxation. Then we have statement of changes in equity, extract, which we have dividends paid. All right. Now we have additional information. An additional information here, non-controlling interest is measured at its proportionate share of the identifiable net assets. Goodwill on acquisition was fully written off 3 years ago. All right, so we have the requirements here. Prepare the consolidated statement of profit or loss for the year ended 31st December 20xxx. All right, so we have the heading consolidated statement of profit or loss for the year ended. Then we'll have our figures here, just as we have in the consolidated statements of financial position. We have our parents, we have the subsidiary, we have any adjustments, and then we have the group figure. So let's go. So I already have a pro forma statement here. So let's insert the figures and then, so unlike the consolidated statement of financial position where we do a lot of workings before inserting the figures, this one we are going to input the figures line by line. All right, so we have the revenue. We have our revenue figure there, and then I can copy this across using Control R. Sorry. So we have our revenue 14,000. Then, as I said, I'm going to leave the question in the video description so you can download it and follow along. So for S is going to be 12,000. Then our cost of sales, we have 9,000 for the parent, and then we have 4,000 for the subsidiary. All right. Then for administrative expenses, this is the pro forma consolidated statement of profit or loss. So we are going to insert the figures first before we come to the group. All right. So we have the administrative expenses. They include 2,000 for the parent and 6,000 for the subsidiary. Then we are going to subtract that from our cost of gross profit to get our operating profit. Then we have income from associates. This is the new figure here. Income from associates. We're going to deal with that. So as I said, the income from associates comes after our operating profit. Then we are going to add that to our operating profit to get our profit before taxation. Then we'll have our income taxes. The income taxes for my parents is here 1,000, and then for the subsidiary is 1,200. Then we'll have our profit for the year. So this one too doesn't have any adjustments for our revenue and cost of sales. So quickly we can just go there and we are going to add those figures together. And we are not going to time apportion the subsidiaries figures because the subsidiary wasn't bought mid-year. It wasn't bought mid-year. So we are going to add the figures just as we have them there. So let me use my alt equals to see. Sorry. Alt equals, we have 26,000. I can copy this across using Control D, and then my gross profit is going to be this minus this. Let me insert my bottom border there. Then that is our gross profit. Then we can have our administrative expenses, which I can also add using alt equals. So I have my alt equals there, 8,000. Then this is going to be subtracted as well. So quickly I can even put this as a minus right here. So minus, and then I'll have my negative figure there. So I'll have this plus this, and that gives me 5,000 as my operating profit. And then the income from associates. The income from associates is going to be the associates post-acquisition profit multiplied by the parent's shareholding in the associate. That is the income from associate or the profit from the associate. So this is going to be equal to what is our associate's profit in the post-acquisition period. Now the associate's profit is 2,000 as we have here. Profit after tax is 2,000. We are going to pick that figure and then you are going to multiply it by the percentage holding of the parent within the associates, and that is 40%, so 0.4. So when it comes to the share of the profit of the associate figure, all we are doing is that we will calculate the post acquisition profit of the associate, and we are talking about the profit that the associate has made since its acquisition by the parents. So that is what we have there, and then we are going to multiply that figure by the parents' shareholding in the associate, and in this case is 40%. So that is what we have right here. So I can add these two figures. And that will give me my profit before tax of 5,800. So let me insert my border once again. and then I can subtract my tax. So using alt equals, let me like this, and then I can have that, but let me put it as a minus. So I'll put minus in front of it right there. Then I can have my this is going to be the profit before taxation, and then I'm going to subtract my income tax expenses, and that gives me my profit after tax or profit for the year of 3,600. Let me bolden that, and then also insert my borders. So top and then double bottom border there. Then when it comes to as we already know, when it comes to the consolidated statement of profit or loss, we are going to have a section for splitting the profits between the owners of the parents and then the non-controlling interest. So what we have here is that we are going to have profit attributable to, so we have profit attributable to one, owners of the parent, and then NCI. So what is the NCI? What is the profit of our subsidiary? When it comes to the share of the profit of the NCI, we pick the profit after tax of the subsidiary, and then we are going to adjust it for the post-acquisition profit. So we are going to pick the post-acquisition profit of the subsidiary, and then we are going to multiply that by the non-controlling interest percentage to get our non-controlling interest share of this particular amount. So I'll come here and so let me just do it right here. So I'm going to have equals the 800, which we have here, which we know to the best of our knowledge to be the post-acquisition profit of the subsidiary. So we have that, and then we're going to multiply that by the percentage holding of the NCI, which is 0.2 or 20%. So that is 160. So this 160 is going to be subtracted from our profit figure for the year, and that will give us the profit attributable to the parents owners. So I'll have this figure here minus the 160 right here to get our share of the owners of the parents. All right, so that is it. That is it for the consolidated statement of profit or loss and other comprehensive income. Now in the question we have a statement of changes in equity. This is not significant as the item relates to the parent only. So we are just going to pick the parent's figure here only. All right. So that is it. That's as simple as that. Right. So the group structure is right there for your perusal. So that is it for as an introduction to statement of profit or loss and the consolidated statement of financial position when it comes to associates. Now, this is just an introduction. In my next video, we are going to look at some of the detailed treatment of some items. So, we are going to look at a detail. We are going to look into detail impairments, how to treat impairments, if there is any provision for unrealized profits. If there is any unrealized profits, we are going to look at how we are going to treat all of that, how we are going to treat dividend payments from the associates to the parents. All right. So we are going to look at that in a very comprehensive question. So stay tuned to my channel. Please subscribe to the channel if this is your first time on my channel, and also consider liking the video, sharing it with others so they can also benefit from what I've shared with you in this video. So I'll see you in the next video.